Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I guess, guys, say it. TG?
TGI, God, it's Friday. Oh, man.
Well, we're coming to you live.
Why do we look forward to Friday so much?
I have to say this. We're coming to you live from the CNBC-TV18 Motilal Studios. I'm Prashant and Sony Nigeria with us.
Love that too.
No, that's the most important thing to say. But now we should start talking about why we talk about Friday so much, right? But I mean, it's been a kind of a rough week, a week that was all over the place, and little bit of caution as well in the system.
Well, let's hope that it's a good Friday then for the Bulls. For starters, it's not looking so good, but let's hope we end pretty good. And then next week is a lighter week, right? Yeah. We have a truncated week. For the kids, there are 2 days holidays.
Yes.
So lots to look forward to.
Absolutely.
15th and 16th, right?
Yeah,
Both
for them.
Yeah, and for us,
one.
Which is serious. All right. Well, let's just quickly tell you what you need to know as we start another session. Basically, the last 2 days, end to end, right? I mean, if you track the markets from Tuesday's close to yesterday's close, the Nifty has moved 20 points. We got a flourish of a move on Wednesday after Tuesday's down move. Wednesday saw a nice, decent bump up, but yesterday we could not follow through. That's point number one. So the Nifty failed to see a follow through after day before yesterday and what the market did. I'll get to levels, etc., in just a bit in terms of what the market needs to do. But U.S. markets ended sharply off the intraday highs yesterday. So there was not very much. At one point, it looked like the S&P, the Nasdaq, etc., would be up between 1.5%. But into close, the last 30-40 minutes, indices dipped and we ended absolutely flat. We got data, right? I mean, so you had U.S. CPI numbers, which came in on the softer end of consensus expectations. The thing, though, is that this was largely in line. You know, it was not a big miss or anything of that sort. This was in line, and there was a little bit of nuance as well. For example, the year-on-year number is ticked up for the first time in a long time, basically telling you that the favorable base impact perhaps is behind. But otherwise, I mean, most indicators are that CPI data was good, which should be enough for the Fed to, in a way, skip hiking in the month of September. There are still those who say, well, you know, maybe September they don't do anything, but later in November there is a hike which is coming, the one after the September meeting. You may be surprised, but the 10-year yield actually went up 10 basis points. Softer inflation is a pause in interest rates, right? So yields should go down, but yields went up 10 basis points, but that's got nothing to do with the data. There was a treasury auction which was poorly received, and that's the reason why yields were up. But, the 10-year is now back at about 4.1% or so. Oil prices, which have been marching upwards, they were down. I think that's positive news flow as we start this morning. Oil prices down about 1.5% or so. Let's get to levels on the indices. I mean, actually, I would say the read-through from global is not negative. It is largely positive. I mean, the big one, which is the CPI, there was no great, blowout on the upside. It's in line, but it's good. And, of course, the indication for what the Fed will do. So, all in all, I mean, this morning we start with decent cues. Now, we need to break out on the Nifty from the congestion zone of 19,630. I mean, if you just take a look at the last 3, 4, 5 sessions, the market has stalled around this 19,630, 19,645 zone. You need to kind of cross this. We left off just about 100 points under it at 19,540 in trade yesterday. Above that, above this congestion zone, you got the 20-day moving average. Basically, it's around the same levels. That stands at 19,664. So these are the two levels you need to cross and then stay above for this slight pullback that we've seen over the last 1 week or so to reverse. But you need a close, not just intraday moves. On the Nifty Bank, the low, by the way, I mean, if you want to look at supports, 19,470 or so, which was the low, I think, on Wednesday. Actually, sorry, yesterday's low is 19,467. That can be used as a near-term support level. On the Nifty Bank, we yesterday broke below Wednesday's low of 44,533. Here, things are perhaps looking a little weak. That CRR move from the RBI perhaps has hurt banks yesterday. The Nifty Bank needs to move above the 40 hourly exponential moving average, which stands at 44,823. That's the first level I would watch out for. That's about 300 points away, less than 1%, but that's the first one. The low of 44,280 for the Nifty Bank comes in as a bit of a support. So this is broadly the setup in terms of levels, etc. So watch that 19,630, 645 congestion zone on the Nifty, and above that, perhaps things will start to look a little better. Implied open is a little soft, 50 points lower this morning. Sonia.
Oh, absolutely, right. And we know that the market has been very range-bound last 4 or 5 days. The Nifty has been stuck in a tight range for 4 trading sessions now. But there are some positives that the street will latch on to as well. For one thing, the foreign investors have been buying in the cash markets for 2 days now, and it's been almost 1,000 crores of buying that we've seen from FIIs. In fact, yesterday, even the DIIs bought in the cash market. So definitely, there is a bullish hue on this market, give and take all the range-bound moves. The Nifty is facing resistance at that 19,800 mark on the upside. So that's a crucial level to watch. Let's see if that gets taken out. But the uptrend is definitely intact, barring for a few spaces like banks. And I'll come to that in a bit. As Prashant was also pointing out, there's a big positive cue that we're working with. Overall, the US inflation has cooled off more than expected. The US markets yesterday ended marginally in the green. The Dow futures are also indicating a green start. So perhaps the dips could be bought later today. We'll wait and watch. But the drag for this market definitely has been banks for the last 1 month or so. The bank Nifty is now below the 50 DMA. And post the RBI policy as well, we know that all scheduled banks will now need to maintain an incremental CRR of 10% between May and July. So that would put added pressure on them. But in any case, even before that, right, the Nifty Bank, if you look at it from the highs in July, the Nifty Bank is now down 3.5%. So that's the big pressure pocket for this market. Until that recovers, the market may not get above that 19,800 mark. In result reactions, very quickly, a couple of good numbers that we've seen. There's Hero Motocorp, there's Torrent Power, there's MTAR Tech. Apollo Tyres was also a decent set, but the stock has run up a lot and little bit of margin pressure in the European business. So that perhaps could keep Apollo Tyres a bit subdued. But lots of stock-specific action. Largely, I think the market could start a bit soft today.
Well, that's right, Sonia. It may not be such a bad thing. And, data has been suggesting that you look to buy the dip with a stop loss of around 19,425. Let me explain that. The institutions, well, the net selling has reduced. So I like that. That's point number one. The second factor that I normally look at is the FI shorts. And the short positioning has gone up. I like that as well. I like some shorts in the system. Now, why do we talk about 19,425? Last few days, we've gone down to those levels. In the month of August itself, numerous times you've gone to that vicinity of around 19,400, 19,450. And from there, you have bounced either, 100 points, 150, 200 points on. So, yes, we're still in that range, that 250-point range on. But you'll fancy your chances if the Nifty moves a little bit lower. Now, on the FIs in the FNO market, what did they do? Yesterday, they added 10,000, 11,000 short contracts, in fact. And the short positioning goes up to around 59%. But the point that I made earlier was with regard to their net short positions, and I look at it in absolute terms. Remember, when it went to around 40,000 contracts, we did see a bit of a bounce. We went down to 19,300 and quickly bounced close to around 300 points or thereabouts. Now, yet again, the short positioning has gone up. From the start of the week, in fact, it's gone up to around 34,000 short contracts odd. If you start off lower, maybe you get a 60, 70-point dip. Some of those shorts may cover out. So let's see how that goes. On the option side, you got the 19,600 call, 19,500 put. Both of them were seeing some bit of writing in yesterday's trading session, which brings us to the levels. On the upside, 19,650, 19,700, well, that's a bit of a resistance zone. The 20 DMA as well falls within that mark. But on the downside, the 19,425 to around 19,450, that's the crucial support zone. You'll want to go in for a risk reward and look to buy the Nifty at some point of time, 50, 60, maybe 70 points lower. The Nifty Bank, that's been off color. It's holding around the 50 DMA odd, but the crucial mark that I'm looking at is the recent low. That's around 44,300. That needs to hold out. If that breaks decisively, we're going to slide down nearly around the 900 points odd. So that becomes very important on the downside, though we're still in a range out there as well, with 45,200 seeing, some bit of resistance. So for starters, we open up in the red. You'll want to see some more red on the screen, and maybe on a Friday, look to get in with a stop loss of around 50 points or thereabouts.
Okay, well, that's the setup as we see it, but let's move on. Before we go any further, let's quickly tell you what's lined up in the first half hour of the show today. We'll get you updates from markets around the globe. Matt Otten of Raymond James Investment will join in to discuss the global setup. Our research team will get you CNBC-TV18's list of top stocks for the day. At 8:30, we do a fundamental stock analysis. Siddharth Kemka of Motilal Oswal Financial Services joins in with that.
All right, let's kickstart the show with some opinion coming through. First up, we have Lawrence Belanco of CLSA, who says the theme of rotation out of the high momentum AI and tech-related names into laggards continues across markets. In Asia, he says that is encapsulated in the unfolding correction in North Asian markets in Japan, Taiwan and Korea, with rebound rallies continuing to unfold in Hong Kong, China and the ASEAN markets. On the macro front, he says the US 10-year yield looks to be capped at the 4.05 to 4.33% resistance zone. The US dollar has rebounded to key resistance provided by the falling 200 DMA, and the Brent oil and natural gas prices threaten to break out of their respective year-to-date bases.
Okay, money market views now. V. Lakshmanan of Federal Bank says the MPC decision to hold rates and US CPI showing signs of cooling is giving the rupee and G7 currencies strength against the USD. He says rupee touched one-week highs against the dollar yesterday at 82.68 to a dollar. During trading hours, he expects the rupee to trade in a range of 82.28 to 82.86 for the next few trading sessions.
And on the bonds, Lakshmanan says bonds traded in a tight range on policy day yesterday, and the 10-year benchmark bond yield is expected to consolidate in a range of 7.13 to 7.18% today. He says the US CPI is below expectations that can boost sentiment in the domestic market.
All right, we have a lot of stock-specific action to track for you today. We get to that in just a bit. But for the time being, let's run you through the list. Well, we're looking at a lot of stocks. Hero MotoCorp, HCL Tech, SAIL, Global Health, that's Medanta, as well as Endurance Technologies. All of them will be on the back of our radar on positive news flow. So split down the middle. 5 are likely to open up in the green, 5 in the red. We have Biocon, Mascon Dock, Apollo Tyres, Concord, as well as LIC. They are stocks that could be reacting to negative news flow overnight.
Okay, well, Matt Orton is Chief Market Strategist at Raymond James Investment. He's joining us now. Matt, great to have you with us here on the program as always. Thank you very much for your time. Will we get a pause in September? Many are saying that maybe the Fed is done now because there is cooling which is showing through. All the numbers were in line. There was no large, how should I say, beat or miss, depending on how you want to look at the US CPI number. What's your sense and what does it mean for markets?
Hey, good morning, Prashant. And I think the CPI data was definitely encouraging. And I think the data last month, this month, it really gives the Fed the room to pause. But I think it's too early for anyone to be saying and declaring that mission has been accomplished because, as you noted earlier in the program, the base effects are going away. And there's still some sticky components to inflation that's related to wages, that's related to housing. And that's something that the Fed is going to have to watch. And the consumer in the US has been incredibly resilient, and people are even starting to buy more stuff again when you break down retail sales. So the Fed's going to have to balance all of this. So I think we get a pause in September. Whether or not we can say we're officially done, I'm not so sure yet. But the one conclusion is that rates are going to remain higher. And, I've been traveling the past month talking to clients all around the country. And one of the most common questions that they ask me is related to this is, are we done with inflation? Are we done with this overhang to the overall market? And the answer is just, I'm not sure yet. And so how that influences where you look for investments, it's playing this broadening of the market that we've talked about before. It's encouraging to see over the past 2 months, the more cyclical parts of the market starting to work, not just in the US, but globally. We're moving away from just the mega cap technology names. And even over the past month, you're seeing strength in energy. You're seeing strength in industrials and consumer staples, healthcare, places where earnings are actually encouraging. So there's still a lot of opportunities in the markets for clients to move into that and maybe take some profits on their biggest winners this year. And then also look to diversify overseas because emerging markets, especially EM ex-China, I think still continue to look very, very compelling.
Okay, that's the cue that we're going to take, right? Emerging markets ex of China still look compelling. I mean, we've seen almost $16 billion get pumped into the Indian market so far this year, the best that we've seen in a long time. So how are you feeling about that, Matt? Do you think India is still the preferred pick amongst emerging markets ex of China? And is there more to go on the upside?
Yeah, hi, Sonia. And I think it's encouraging to see interest in India. And it's funny, for the first time, I think in a very, very long time, talking to clients about India, they're receptive to the overall conversation. So I think when we look at the possible investment perspective going forward, the correction that we've had so far in India, if you can even call it a correction, is healthy. Seeing some sort of orderly consolidation is what we need coming off of all-time highs. And so when I look at the Indian market, it's encouraging to see foreign money coming in. I think that's going to continue, especially based on the conversations I've had with institutions, retail clients here in the US. People are catching on to the long-term value that's in India. And so I think banks, even though there's been a little bit of recent weakness, I think still continue to look attractive. Industrials, particularly aerospace and defense, anything related to infrastructure spending, especially ports, which are going to become more and more important to supply chains reshore and move over to India. All of those are great long-term investment opportunities. And valuation overall still fairly attractive given, I think, the earnings momentum that we're seeing. I mean, earnings season's been pretty strong in India. So I think there's still a lot of opportunities, and I would use downside opportunistically.
All right. Hi, Matt. Good morning. Matt, from an India perspective, we don't want to see crude oil prices spike up. Now, Chinese demand hasn't really come back, but you're having supply cuts, and that's what's pushing up crude oil prices. So as a house, I want to know, what's your view out there? Do you believe that it's now at the upper end? Or from an India perspective, which will not like it at all, do you see it even trend higher from here?
Hey, Nigel, I think the crude oil prices can continue to drift a little bit higher. I was actually surprised by how low they went earlier this year, given the fact there have been persistent supply constraints. We have the ongoing war between Russia and Ukraine. You've had a drawdown of the strategic petroleum reserve here in the US. And people around the world, even in China, people are traveling more. So the demand part of the equation hasn't receded either. So especially as you see more.
Okay, there's a bit of an issue with that video. So, Matt, we're going to have to let it go on that note. Thanks a lot for joining in. Appreciate your thoughts here. That's Raymond James Investment talking about how Asia ex-China continues to be, emerging markets ex-China actually continues to be a great place to be because of the sharp run-up that developed markets have already seen, and India is one of their preferred picks there. Let's slip into a quick break. On the other side, lots of stocks to talk about as we begin a brand new day of trade. Stay tuned. Welcome back to Bazaar Morning Call. It's a Friday morning and we begin the day with a lot of stocks that you need to watch out for today. First up, there's Hero MotoCorp on our list. Now, we're going with green over there because the operational results were better than what the street was estimating. It's the fourth consecutive quarter of a margin gain that Hero MotoCorp has seen, and the margins have gone up 260 basis points year on year at about 13.8%. Now, if you look at the core numbers, the revenue growth is in low single digit. So about 4.5% growth is what we've seen. It's lower than what the street was estimating. So in that context, a little bit of a disappointment on the top line, but it's the operational performance that the street may latch on to. The profit growth has also been quite strong at about 32.1%. Let's also not forget that Hero MotoCorp has underperformed the street this year. The two-wheeler space particularly. The stock is up barely about 10%, while peers like Bajaj and TVS are up about 20 and 30% respectively. So a little bit of a catch-up over there. So I'm going with green on account of good operational performance.
Okay, all right. Sonia, thanks for that. And the other stock that's going to be in the green is HCL Tech. Big deal one overnight. Rima, tell us more.
Yes, this is a very large deal by HCL Tech. $2.1 billion. It's a net new deal spread over 6 years, starting from November, and the deal has been given to them by Verizon. Now, according to the analysts, if you do a very simplistic calculation, right, $2.1 billion divided by 6 years, and then if you assume, how much will it contribute for 5 months of the year, then you come to a number of $145 million. Now, whether it plays out or not, because the ramp up of the deal may differ, it's approximately about 1% of their FY24 guidance. It basically gives the street comfort that the company will now be able to achieve its FY24 top line guidance of 6 to 8%. This is the single largest services deal won by the company, and after the very weak Q1 print, this deal win will provide comfort about the current quarter and even the company achieving their full year revenue guidance. Back to you.
Okay, well, thanks very much for that. Do note we will connect with the management of HCL Tech and Verizon business at 9 this morning. So more details in that one. Well, let's move on to Biocon. Ekta is here with details on the numbers. Ekta, morning.
Morning. Well, the numbers are not comparable for Biocon this year because there is a full integration of Viatris, which is the biosimilar business. But the revenue is up 60% on a comparison. It is missed estimates. So the street was working with a growth of around 68%. Margins 20.9%. Street was anticipating 25%. And profit of 101.4 crores. The street was anticipating around 170 crores. So it is a top-down miss. Despite the integration which has taken place, it has missed the estimates that the street was working with. Even on a Q-on-Q basis, margins are 20.9% versus 26.4%. But the correct way to look at the numbers is versus the estimates this quarter. Now, in terms of the biosimilars, it's 57% of their total sales, 2015 crores versus estimates of 2013 crores. 2015 crores compares to 2100 in the previous quarter. So the real miss has actually come in on the margins, and I think the street would be disappointed with that. But remember that this is the first quarter for full integration. So the commentary from the management, where the conference call is at 9 a.m., will also be crucially watched.
Okay, all right. Thanks a lot for that, Ekta. Well, let's focus on the metals pack then. SAIL, the numbers were pretty good. They're better than what we were working with at least, or better than the low expectations. Let's put it that way. On the top line itself, there was a beat. The EBITDA number as well was better than what we were working with. And margins as well came in 50 basis points better than what we were working with. Let's run you through the key reasons out there. Realizations, they were actually up on a sequential basis by 1%. Most on the street were expecting weakness, maybe a contraction of 1% to around 2% or thereabouts. You had a couple of costs as well, other expenditure as well as employee costs. Both of them were lower on a year-on-year basis, so that's what helped their cause. The problem for them is the debt number has moved up a little bit. It appears that working capital, could have got stretched a little bit. And the gross debt number has moved up to around 29,400 crores odd. Street was expecting it to go up by 2,500-3,000 crores odd. So some kind of clarity on that front. For the time being, we're going with green on the back of a better operational performance.
Okay.
Ekta, coming back to you. Medanta as well, there is some news out there. Tell us more.
Well, the numbers look good. Revenue up 25%, EBITDA is up 34%, margins 23% versus 21.5% year on year, and profit has done well as well. But the big news with Medanta is that they will be tying up with DLF Group. They've entered into an understanding. This is to launch a 400-bed multi-super speciality hospital in Delhi. and both Medanta and DLF will own 50-50 equity in the new company. The facility is expected to strengthen Medanta's presence in the NCR region of Delhi. You can imagine how fancy that hospital might be.
However fancy a hospital is, we don't want to ever get there, right? But yeah, of course, for the stock, I mean, good going, good earnings, and a large, hospital in NCR.
Absolutely. Well, Mazgaon Dock is the next one, which is in focus. Vivek is here with details. Vivek, morning.
Well, good morning. Slightly soft operational quarter as far as Mazgaon Dock is concerned. Execution continues to be quite lumpy, and which is the reason why, earnings at this point of time slightly subdued when you're comparing it on a year-on-year basis. Revenues lower by 2.5%, coming in over the 2,170 crore mark. However, EBITDA too is down over 1%, and this time around margins have come in steady at the 7.9% mark. Profitability, largely aided by very strong other income, is up 40%, coming in at the 314 crore mark. Now, talking about the order book, order book continues to remain very strong, well in excess of 39,000 crore. Shipbuilding portion is, as expected, the largest part, over 32,000 crore. This time around, the submarine as well as the heavy engineering portion comes in at over 6,400 crore.
All right, thanks a lot for that. Two stocks that I'm watching, Apollo Tyres is one of them. I'm going with red on Apollo Tyres because it's been a mixed bag this time around. The revenue growth is in low single digit. It's just a 5% revenue growth that you've seen this time for Apollo Tyres. The EBITDA is strong, about 52% higher compared to last year. Margins are up 530 basis points. But if you look at the breakup, while the Asia-Pacific business is stable, Europe continues to see a bit of pressure, especially on the EBIT side. So if you look at it, for the European business, the EBIT is down about 16%. But, and also, the stock has rallied substantially. I mean, the Apollo Tyres stock is up almost, I think, 40% from, 84% in the last 1 year. So I'm going with red on that one. But the stock that could be in the green this morning is Endurance Tech. Very strong numbers coming in, revenue growth of almost 16%, profit growth of about 60%, and Endurance is doing a lot in the electric vehicle space. So they've seen, we are seeing a rapid transition in EVs, a rapid transition to EVs and hybrid cars in Europe, and Endurance has a large presence there. So the EV orders as a percentage of their overall order book has risen from just 12% in FY22 to about 42% in FY23, and the EV core absolute order book has also gone up quite a bit, as you can see on the screen, almost 400 crores now. So I'm going with green on Endurance Tech. But Mangalam is here with us to tell us why he's watching Concord this morning. Mangalam.
A soft performance coming in from Concord this time around. We already had their volume details. The overall volumes of the company grew by around 7.95% during the quarter. But has that reflected into revenues? Not, because lower realizations has meant that the revenues have declined by about 3.5%. And as a result of which, that's flown down to the EBIT as well. The EBITDA is actually down by about 17%. The margins have compressed by about 350 basis points. And the net profit for the company has corrected by about 17.5% as well. There's been a decline across both their segments, the EXIM segment as well as the domestic segment. The EXIM revenues have declined by 5%. The domestic revenues have been flat, but the EBIT out there has declined by 36%. And this despite, like I said, volumes for the company growing by 7.95%. This was disclosed earlier. Domestic volumes growing 10.5% on a low base, and EXIM volumes growing by 7.2% as well. The other thing, it's the start of a new financial year, so obviously their land license fee rate increases as well. So the quarterly run rate this time around is about 130 crores as against the 90 to 100 crores that we were seeing over the last few quarters.
All right. Mangalam, thanks very much for that. And now the largest insurance company reported as well. Surabhi's got details in this one, LIC. Surabhi, morning.
Morning. Thanks for that. So LIC, it was a weak quarter for them. The total APE was down 7%. The value of new business was also down 6.8% on a year-on-year basis. The margins were largely flat, came in at 13.7%. The street was working with a 15% mark. This is despite the share of non-par and retail APE growing at nearly 300 basis points, came in at 10.2%. The market share in their policies and premium both were down 4%. So it was a weak quarter for LIC.
Okay, weak quarter. Thanks a lot for that. Here's a quick recap of our top stocks with positive news flow. There's Hero MotoCorp, HCL Tech, SAIL, Medanta and Endurance Technologies, while stocks with negative news flow, there's Biocon, Mazgaon Dock, Apollo Tyres, Concord and LIC. But the other big headline globally is what's happening in the world of crude. It's been a multi-month high for crude prices. Crude prices are now almost, Brent crude is at $86 a barrel. Manisha Gupta joins in for a roundup of all the action there. Manisha, hi, good morning.
Morning, Sonia. Thank you for that. Yes, we are closing or holding close to a 9-month highs We have seen 87.5 in the New York session yesterday, so the gains have been quite consistent. This is going to be a 7th straight week of gain for the crude oil prices. The last 6 weeks, we've seen crude prices gain up by nearly 18%. There is speculation that another U.S. rate hike perhaps will not happen in the month of September. There's a 90% probability of that showing now. That has been supportive. Apart from that, the Russia and OPEC output cuts have been supportive. In any case, they have deepened their output cuts for the month of September and going forward in October as well. And then apart from that, this is record Atlantic Ocean heat, and that may lead to strong hurricane season going forward. That continues until October, November. That sentiment is playing into the markets as well. And finally, the OPEC monthly report that came in yesterday has forecasted robust demand in this year and the next as well, between 2.25 million to 2.4 million barrels per day, and that has led to a fresh surge in prices.
All right, Manisha, thanks very much for that. Well, that's commodities and oil specifically in sharp focus. We'll take a quick commercial break here. We'll be joined by Siddharth Khemka, Head of Retail Research at Motilal Oswal Financial Services. We talk stocks, themes that he wants to bet on later. We'll also be joined by Dr. B.S. Ajay Kumar, Chairman and CEO of Healthcare Global Enterprises. So stay tuned. Both those conversations coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Hope you're having a good Friday morning. We'll just run you through all the stocks that we're tracking in our special Top 10 segment. And to help us analyze it further, we're joined by Siddharth Khemka, Head Retail Research at Motilal Oswal Financial Services. who joins us on the show. Hi, Sid. Morning. Thanks so much for joining in. Well, the stock of the last hour yesterday was Zee Entertainment. They've got the go-ahead from the NCLT. And now, in fact, that the valuation as well you'll give it, the market capitalization could be far higher from what we saw prior to that order. But at around 280 rupees, how much of the good news is in the price?
Yeah, very good morning, Nigel. Thanks for having me on your show. So if you look at the entire street was waiting for this event to happen, which was the biggest overhang on the way ahead for Zee-Sony merger. And now with the NCLT approval, we have already got the exchanges and the other shareholders' approval for the same. So I think that paves way for the merger of two large entities and making it one of the largest media powerhouse in India. Going forward, there would still be some concerns with regards to the management of the merged entity, given that the regulators have kind of come out and they have come out and said that the Zee management cannot continue as directors. So we'll have to see on that. So that is a little bit of overhang, but I think there are a lot of growth opportunities. We see that the merged entities enterprise value, even if we adjust for the 1.6 billion cash infusion by Sony, stands at a good 358 billion rupees. And we see that the combined entity can generate revenues around 190 billion rupees with a 10% blended margins. Which kind of, so at current valuations of EV/EBITDA of 19x, we see that there is a negative value for the OTT business, which we don't think is justified. Even if we give a zero valuation for the OTT, we believe that the current valuations do not capture the strong growth opportunities and the content investments. So we think it's a good growth opportunity. There could be further upside, and the target price revision would keep happening as and when the synergies keep flowing in. For now, we have upgraded our target price from about 280 to 320, and we believe that this is a good step for the Zee-Sony merger going ahead.
Okay. Siddharth, hi, good morning. I wanted your thoughts on HCL Tech. That's a pretty large order that they've won, right, from Verizon, over $2 billion. Of course, it's spread over 6 years. But the stock, if you notice, in the last 1 year, from a low of around 900, now it's back to about 1130. Is the risk reward favorable for investors, long-term investors?
So, Sonia, I think this is a good deal that they have announced, a 2.1 billion deal from Verizon to provide the management network services to Verizon's client, which includes the post-sale implementation and ongoing support, which would be a period of 6 years, and also includes transition of some of the employees from Verizon to HCL Tech. We see that this can be a potentially good large order, and the 2.1 billion is a minimum committed value and can potentially increase if the venture performs well. So our initial calculation shows that the deal could add about 110 basis points of additional revenue to FY24 and about 230 basis points additional revenue in FY25, and which would majorly ease the concerns of investors with regards to the company's FY24 revenue growth guidance, which is in terms of 6.5 to 8.5% growth Y-on-Y. So I think largely these deals kinds of paves way for the investor concerns to kind of get allied, and definitely looks good. We currently have a buy rating with a target price of 1280, which is kind of 10% upside, but definitely we'll have to have greater working on this deal and could lead to further upside. So I think risk reward is still favorable. The valuations for HCL Tech is kind of comfortable, and it's a positive news for HCL Tech.
Siddharth, hi, good morning. Any results, any stocks based on results, etc., you want to highlight, which your team, etc., is very excited about?
So yeah, Prashant, good morning. So I think some of the lot of result season going on. Grasim came out with very strong numbers with a strong recovery in the core VSF business. We saw the chemical business operating profit margins also improving sequentially. So overall EBITDA growth was much ahead of our expectation. Operating margins of 10.8% was again much ahead of our expectation of 8.2%. As I said, the beat was driven by the VSF segment that kind of see a good EBITDA per kg at almost 20 rupees compared to our expectation of 14 rupees. So overall, we see that it's a strong recovery, especially in the core businesses of VSF and chemicals. We see that margins in both the businesses have now almost bottomed out. Lower input costs aids improvement. So it's a good in a commodity business when you see the margins kind of bottoming out, improvement, the cycle. So that's kind of a good sign for the business. We have a target price of 2,100, which is a good 15% upside from current levels.
Okay, thanks a lot, Siddharth, for that. Just stay on. We'll come back to you in a bit. We have plenty of other questions to ask you, whether it's a lot of these auto numbers which have looked very good. But in the meantime, we also have a management joining us now. Healthcare Global Enterprises posted a steady set of numbers. The emerging hospitals witnessed a strong business momentum while the margins contracted a little bit. To discuss this, we're joined by B.S. Ajay Kumar, the Chairman and CEO of Healthcare Global Enterprises. Mr. Ajay Kumar, good morning and thanks for joining in. I want to start by asking you about the cancer centers, which are up almost 14% this time in terms of a growth. Can you tell us how were the occupancies in this quarter? What's the average revenue per bed that you've seen in this quarter across your centers? And what kind of growth are you looking at for the rest of the fiscal?
Now, our occupancy now has in the mature center is over almost 68%. And in the centers which are emerging, it is also about 67%. So we are reaching our target of about 70 to 75%. And our ARPOP, ARPOP has also increased in the mature center to 41,000. An important thing is even our emerging centers have actually shown 35,000. So there has been a good improvement in both sectors, and we see that our emerging center will also catch up with the mature centers very soon. That is our hope. Probably in the third to fourth quarter, it will happen.
So for your emerging centers, the growth has been good, but it's come at the cost of margins. Your margins have come off to about 9%, and you used to do double-digit margins earlier. Any reason for that, and will this margin pressure continue in the second half?
Yeah, usually what happens is in the first quarter, the margin gets a little bit lower than the last quarter. The EBITDA itself comes down. That is usually 3 to 4. But in this quarter, our margin went down a little bit more because we invested quite a bit in talent in the first quarter. Because we have really brought in very good talent in Mumbai. And also our radiation replacement, but a little bit more time it took. Instead of being up in the first quarter, now it is up in the second quarter. As you will see in the second quarter number, there will be quite a significant improvement. And we are seeing that tracking already happening in July. So we think we will catch up in this second quarter on that. I also want to say that we have also made some acquisitions. I don't know whether you've seen that. We have been very happy to report we acquired a major center in Indore. And this is one of the strategic centers in Indore, one of the largest private centers in Indore which we have acquired. And also we have completed, it is a CBCC center along with SRJ. We have also done acquisition completed as we had spoken last time. It was in the works. We have completed our HCG and CHR in Nagpur. So both of this will put us in a strong place in that territory. Particularly, it will be our entry into Madhya Pradesh. And it will complete our link completely in the eastern part, coming up to Madhya Pradesh and Andhra Pradesh. That was our goal. So this will add a further momentum to our growth in this region.
Right. Congratulations, Dr. Ajay Kumar, on closing out both those two acquisitions, as you have said in the past as well. We've spoken to you about a couple of them as well. Now, I just want to focus on the emerging... Yes. I wanted to focus on the emerging centers, actually. When we had spoken a few months ago, I think we were talking about revenues. You had told us that it's possible that you do revenues of around 475 crores with margins of around 13% for this year. Is that on? It's likely to improve in quarter two, but do you see the margins go to early teens, maybe 12, 13%?
Yeah, definitely we see that happening if you're talking about emerging centers. I think for us, the emerging centers, for example, Borivali doing extraordinarily well. Where we had some issues, which we have taken a lot of corrective measures. Like I said, we brought in talent is in South Mumbai and Calcutta. Entire talent acquisition is complete. And I think we are now going to see significant improvement in both Kolkata and South Mumbai, which will definitely add to our growth of the emerging centers.
Okay, so 475 crores with 13% margins, you're sticking to that, right?
Yes.
Okay, all right. The other factor is you're in the last couple of years, you've paid some consultant fees. Last year it was around 16 crores. The previous quarter, I think it was 4-5 crores. So in total, you spent around 20 crores. And that was likely to help the business structurally, cost savings and also improve the profitability. Are you seeing signs of that in FY24? Will we see some bit of those savings because you've already spent the 20 crores? So now we'll see some results from 24 onwards?
Yeah, we have invested quite a bit in operational efficiency, you're right, as well as in digital. We have done a complete analysis. Our digital market is improving significantly. And it is only the start. As you know, some of these things takes, at least 6 months to 12 months. And we are in the middle of that. And our analysis shows that definitely there is an improvement in both aspects. And we will see that particularly in the third and most probably in the fourth quarter of this year, we'll see the maximum impact.
Okay, two very quick questions. One on debt. Your debt has gone up. It's almost at about 220 crores now. Would you be, looking at higher debt in the year to come? And second, any more acquisitions on the anvil?
Our debt definitely is still compared to our ratio of our EBITDA to debt and all, it's very low. Our debt has always been around 120. Now it will go up a little bit, 150, sorry. It will go up by about 120 crores because of the acquisitions we have done, both in Indore and in Nagpur. But we are also looking at future acquisitions. As you know, some debt we can afford to take more debt because of the strong cash position we are in. And we will be looking at more acquisitions. And as and when we do, of course, we will inform you. And we are very actively looking at it.
Okay, actively looking at acquisitions. Hope to hear from you soon. Thanks a lot, Mr. B.S. Sajay Kumar, for joining us on the channel. That is Healthcare Global with a view on their business. But let's get back to talking about individual stocks now. Siddharth Khemka has been sitting with us. Siddharth, the auto ancillary space has done very well this time, barring a few cases here and there. I mean, just case in point, right? Endurance Tech, very strong numbers, big pickup in the EV business. And if you look at the stock as well, I mean, it's gone from 1100 to 1700 in just the last 6-8 months. What do you do here?
Yeah, so Sonia, if you look at, I think auto was one sector where we were expecting a strong recovery in terms of earnings growth and some of the auto anchors. We also saw the numbers from Motherson, Samvardhan Motherson also coming at very strongly. So overall, if you look at barring the CV side, where because of the pre-buying in the Q4, the growth was a little bit less. But in terms of, if you look at the other segments, growth has been pretty strong. Coming to Endurance Tech, performance was in line with our expectation. Growth has been ahead of the industry, especially in the domestic market. The India revenue grew 13%. If you look at segment-wise also, the growth has been pretty strong. In the three-wheelers and the passenger vehicle segment, overall net profit was pretty strong at 47% growth. Overall, I think we have a positive view on Endurance and a buy rating. There is a con call today at 10 a.m. post which we could revise our target. But I think within the auto space, Endurance sits pretty strongly in the auto ancillary space with diversified presence across two-wheelers, three-wheelers, and the passenger vehicles. Hence, we like the stock. Currently, we have a target price of 2,000 on Endurance.
Okay, what we'll do is we'll take a quick commercial break here. But as we do that, let me quickly tell you what's lined up over the next half hour of the show. We'll get you the top stock picks for the day. Our technical experts will be joining in just a bit from now. And before markets open, CNBC-TV18 Stock Board, we highlight the top stocks to watch right at the open based on news flow or otherwise. Stay tuned. Okay, welcome back. We're about 10 minutes out from the pre-open session. Mitesh and Kush are with us. Kush Bora is with us with technical trading strategy and what to do in terms of specific stocks. Gentlemen, good morning. Great to have both of you here. Mitesh, good to see you here in the studio. How are things looking, Mitesh? I mean, yesterday, there was no follow-through after day before yesterday's move up. The Nifty Bank, went below the previous day's low. Things looking a little muddled. You've had the view that perhaps time to be a little cautious for the last few days now.
Morning, Prashant. So I've been advocating that the market has come out of an uptrend, but we haven't gone into any kind of a significant declining move. I think it's a market which will go through majority of time correction, but will be slightly negatively biased purely because of the previous move, which was on the upside, and therefore it will try to retrace a part of that. My sense is that 19,400, 450 is a good support zone. If that breaks, in the worst case scenario, I'm penciling in 19,200. I think that should be end of it. But this choppy movement, this range-bound consolidation could still extend for a couple of weeks more. So therefore, the idea should be to try and buy closer to 19,400 and try and get into some kind of option-based short-side positions as we get closer to 19,680, 700. Till we start getting past 19,700, I think the overall pressure or the overall immediate trend will be on the negative side.
Okay, Kush Bora is also with us. Kush, the trend is largely on the negative side because of what's happening with the bank Nifty, right? I mean, it's lost so much ground, about 3-4% since the highs in July. So what's the sense you're getting? Is there more pressure in store there? And overall, what does this mean for the index?
First up, hi Sonia. Good morning to you and all the viewers, and thank you for having me on the show. Well, if you look at Nifty, at least in particular, it's been a tale of two halves in the last week, where we saw a higher high kind of a formation, but in the last couple of sessions, we've sort of gone range bound. Now, I concur with Prashant and Mitesh here that the view is for sure cautious, and I'll give you one additional point to add why. When the Nifty fell from 19,700 to 19,300 odd levels, the broader markets actually saw a very sharp sell-off. We saw a similar setup yesterday, and hence the caution. It'll be a conditional trade. 19,450 is my support zone here. If the Nifty comes to this level, breaks below it, I would actually go short for targets of 19,300 and 19,150 with a stop loss of 19,600. You're absolutely right about Bank Nifty. The sluggishness here, the weakness here is actually slightly more protruded compared to the Nifty. So the view remains same. The level here is 44,400 that I'm watching for. Below this, I'd actually go short for targets of 44,000 on the Bank Nifty as well.
Okay, got that. Let's get to specific trading ideas. Mitesh, why don't you take us through what you have?
So, Prashant, I have a mix of buy and sell calls. On the buying side is Coromandel Fertilizers. It's breaking into all-time highs. So, from a trading point of view, buy here with a stop below 1,060 for targets of 1110 to begin with, and maybe higher levels can happen later. Sun TV is a buy with a stop at 540 for targets of around 570. A sell on granules, and it was in news with the numbers being out yesterday. I think it will see more downside. So sell with a stop at 308 for targets of around 290. And Pidilite also had a big breakdown. So on a mild pullback, try selling around 25.30 with a stop at 25.80 for targets below 24.50.
Okay, all right. Thanks for that, Mitesh. Kush, coming across to you as well. Give us some trading picks for the day.
Sure. Despite the cautious view, there are still pockets, in the market that are doing well. So I have two calls, both on the buy side, one from FNO and one from cash. JSW Steel, the stock's actually seen quite a bit of, move already. And for the most part, it's respected its 20-day moving average and, rebounding from there. So 840, 850 are my trading targets on this one. 820 is where I would keep my stop loss. From the cash segment, Data Patterns is one stock that has actually come out of a consolidation range and is given a very clear breakout. So I'd be a buyer on this. 2160, 2220 are my targets. 2060 is my stop loss. And as a disclaimer, these calls have been discussed with our clients as a part of our advisory service.
All right. Thanks a lot for that, Mitesh and Kush. Thanks for joining in and giving us all your stock ideas. But let's go across to Vivek now. There are some, key MSCI changes that will take place. So Vivek is here to get us up to speed on that. Vivek, morning.
Well, good morning. MSCI has gone ahead and released the list of inclusions as well as exclusions as part of the Global Standard Index review. This happened early today morning. Most of the inclusions, most of the changes are largely along expected lines, that we've been pointing out even yesterday. A few surprises, and we'll mention that. So for, a couple of changes and couple of inclusions. Number one, Astral expect flows of close to $176 million. These are as per IIFL, alternate research estimates. Cummins, $178 million worth of flows. Ashok Leyland, IDFC First Bank, HDFC AMC, as well as PFC. All of these are also inclusions into the MSCI Global Standard Index. Two more stocks, that wasn't part of many of the quant analyst estimates as far as, likely inclusion candidates, but they have come in. REC, expect flows of $190 million, and Supreme Industries, almost $177 million worth of flows that will come into this particular counter. On the other hand, one stock that would be excluded from the index is ACC. Along with that, there have been changes that have been announced as part of MSCI India Domestic Small Cap Index. So 41 inclusions as well as 2 deletions from there. Along with that, MSCI has also given a statement as far as the treatment of Adani Group stocks are concerned. They have deferred any weight changes in the Adani Group stocks till they get further clarity as far as the the FIF factor, that is the foreign inclusion factor, on all of these stocks.
All right. That's an important story, and we'll keep coming back to it for more perspective. Vivek, thank you very much for joining us and running us through that. There's 4 minutes to go for the pre-open session. We are back in just a bit. Anil Ganju of HCL Tech and Massimo Perselli of Verizon Business will discuss the deal worth $2.1 billion, which was inked between both entities in just a bit from now. A little later after that, we'll have Anuj Podar, Managing Director and CEO at Bajaj Electricals, to discuss their first quarter results. Stay tuned.
Welcome back. This is Open Exchange. You're live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. We're just getting into the market opening in a bit. The pre-opening rates will kick in a bit, so we'll wait by for them to adjust. The implied opening suggests that it could be a weak start, but we have a couple of positive cues to reckon with as well, whether it's global cues which are positive. FIIs have been buying for 2 straight days, so let's see how that goes. Manoj Muralidharan, the Vice President Derivatives at Religare Broking, joins us now to talk about that. Manoj, good morning and thanks for joining in. more than the Nifty, I think it's the Bank Nifty that the street is worried about because of the pressure that we've seen. How are you feeling about the chart there, and what are the stocks that you're looking at today?
Good morning, Sonia. Sonia, I guess we need to rewind a bit, just get into how we started the August series. Now, compared to last month, the August started with a higher, almost 25 lakhs in terms of open interest. So we were almost at 1.12 odd crores when we started. The Bank Nifty was lesser by 2.5 lakhs. Now, we need to understand this additional position that we see, even on the FI side, it was more of a shorting. So when you have an index which is being short, so that is necessarily a hedge to the portfolio that is happening. Needless to say, yes, there is some selling from the FI in the cash market, but this index future selling is majorly into your Nifty and Bank Nifty, if not the other two indices. So a question that the Bank Nifty has seen even yesterday a good build-up of around 9.5%. So yes, there is a possibility we might see some underperformance. But then all this culminates to one equation that 19,650 on Nifty is a very crucial level. Above that, I guess all this will cease to act, and then the Nifty will resume an uptrend. Now, having said this, we are starting a new weekly contract. So even after yesterday's expiry, if you see that for the 17th August and for the August series, even if the Nifty trends down to closer to 19,000 odd, that would not be a negative stance, I would say, because of this additional shorting. So that is going to give money to the hedge position that the FIs have. So market is still positionally in a buy on dip, and the dip qualifies to as low as a 19,000. But intraday, let me talk about that, 19,450 to 480 on the futures, that is where the support is, and somewhere close to 19,600 to 630 might be the resistances. Now, stock specific, we believe that pharma is doing good in the August series, and it might continue to do that. But then we wait for the weighted average price at which the foreseen levels or the buying was seen. So Cipla qualifies that at closer to 1245 to 1250. The stop loss should be 1225, and it has a potential to go to almost 1280 as a target. We like ONGC as well. The stock at 177 to 78 is a good support to go along with the 175 the stop loss and the potential target of 184 on the stock.
Okay, all right, Manoj, thanks a lot for that. Well, let's move on then. HCL Tech has secured a $2.1 billion Verizon deal. We spoke to Massimo Pisilli, the Chief Revenue Officer, Global Enterprise and Public Sector at the company, and Anil Ganju, the Chief Growth Officer, TMT RCPG Americas at HCL Tech, about the deal pipeline, the margin guidance, and the impact of this deal for FY24. Let's hear out what they had to say.
Absolutely, delighted to share that, yes, it is HCL Tech's largest services deal and thereby a significant milestone in our services journey. When does it start? It starts from November of 2023. And then, yes, it goes on from there 6+ years. And specifically in terms of revenues, every year, of course, is a little varying, but at the same time, we specifically, the revenue for this financial year is something, it will be aligned to the market guidance that we have already provided most recently. As you remember, we did mention once again in our earnings call that the pipeline and the funnel is at its all-time high. And we talked about the whole process of now converting that into wins. And here is one of our most significant ones that we have announced. It continues to still stay very robust, very strong. And we are actually working on significant other similar transactions that we are working. And as customers will start finalizing their decisions, it will start getting converted to decisions and announcements. So it is looking very healthy.
Well, for us, it's been a very competitive bid. We went through a number of partners that were part of a bid. We decided to lean on HCL because of the quality of the services and because of the value of the platform, and also because of the innovation that we have planned to bring together to our customers.
Yes, any such large program obviously takes time to start And we have factored for all of those things and ramp up, of course. And we have factored for all that, and which is why the margin and the revenue guidance that we have given, we are absolutely standing by it.
Okay, well, that's, the big deal which was announced. Now, Bajaj Electricals posted a weak set of first quarter numbers. Lighting and switchgear segment witnessed weakness due to subdued demand. Consumer products division also saw very low single-digit growth. To discuss this and more, we are now joined by Anuj Podar, Managing Director and CEO at Bajaj Electricals. Anuj, great to have you with us here on the program. Thanks very much. Prashant this side. So consumer products business revenue grew 2%. In the lighting segment, the revenues are actually down 13%. I want to start with the consumer products business, and there, specifically, what happened to the fans segment. That is the segment which has seen so much competition from newer players. You've actually seen volume degrowth, right? I mean, almost 10% or so. Could you tell us what you saw there and what are we seeing?
That's right. Good morning, Prashant. Thank you for having me. Consumer products business has been relatively flat on top line, 2% growth as you called out, led by the fans degrowth, but the rest of the appliances have actually grown by about 10%. On the fans, it's, I think, really a function of a weak summer. We've all seen unseasonal rains, particularly through most of northern India and parts of western India. That has affected demand for the cooling products. And only other factor playing out in the fan segment is that since 1st January, as you know, the new star rating has kicked in. So I would say, in the case of fans, don't look at one quarter, but look at the last 2 quarters, and I think the next 1 quarter. So over a 9-month period or whatever, I think there's a lot of churn happening in the fans category. But if you look at that on an overall basis, we've actually been growing market share there.
Okay. Anuj, three things. One, could you give us the fans volume degrowth number? And you said 10% for rest of the segment. Is that volume or sales? If you could give us the volume number for the rest of the category in consumer, ex-fans. And 3, there will be a pickup. But is competitive intensity very high, or you think we are perhaps at a bit of a trough now in the fan segment specifically? Go on.
So let me, nuance that a little bit. Firstly, on the volumes, while we don't put out official volumes, if our growth in appliances has been about 10%, you can safely say volume growth is probably 6 to 8% over there across different categories. In the fans case, since you have a value degrowth of 8%, probably the volume degrowth is higher at about 10 to 11%. It's a mix of competitive intensity, but more, I think, one, I called out the weak summer, but also there's an overall weak, muted discretionary consumption demand in the economy. You're seeing that across sectors. I think both of these factors combined are leading to pricing actions or discounts, if I may call it that are not necessarily healthy. So in this kind of an environment, players are discounting. So some of this you're seeing is really a function of the weak demand leading to pricing actions and therefore also soft overall values here.
But even if you look at your other segment, right, which is your lightings business, especially the consumer segment, that has seen a steep fall this time around. Is this double-digit fall something that can continue? And is it particularly to do with something that you guys are not sort of keeping up to speed with the market? Because there is definitely a lot of competitive intensity at the moment. So what are you doing to combat that in the lighting business?
So in the lighting business, it's the consumer lighting and the professional lighting. And the professional lighting, to leave aside the ESL business, that's flat, so there's no degrowth. The consumer lighting has seen a double-digit degrowth. You see the trends in consumer lighting since last 3 quarters. That is an industry trend. That said, in fact, I'm more confident of that coming back faster. I expect Q2 to have growth in the consumer and professional lighting side. I think the larger consumer products is more a function of the economy picking up or the discretionary consumption demand picking up. I think that should happen by the festive season.
Okay, all right. Hi, Anuj. Good morning. Could you tell us in terms of your market share in the fans business because of the new star as well as some kind of demand slowdown as well? That's what hurt the growth. I mean, that's the degrowth out there. So what's your market share? Have you lost some market share? And also for the business on the whole, by which quarter do you get to double digits? That's something that the street has been hoping for. So when does that happen?
So Nigel, on the market share on fans, overall, I would say from a Y-on-Y perspective, not just a quarterly perspective, we moved up from over the last 18 months from somewhere 8+% share to a 10+% share. And from a rank from being a lower ranked player to a number 4 ranked player. So we are gaining market share in the fans category. I'll put in one more data point. Typically, We were known as a sub-economy fans player. About a couple of years ago, about 85% of our revenue contribution in fans was sub-economy fans. In the March quarter, that was about 67%. In the current June quarter, the sub-economy contribution is down to 58%, which means the flip side, the premium and the economy is actually gaining share for us, and therefore our portfolio mix is getting better. So, and that's the reason I'm confident that overall market shares for us are increasing in fans and our mix is getting better. So as the demand, the consumption industry picks up and you get back to a good summer next year, we are well poised in the fans business. Coming back to overall margins, sorry, go on.
Yes, please go ahead.
Yeah. Coming to your question on the overall margins, I think it's really a function of primarily operating leverage or deleverage. The underlying metrics are fine for us. We've done the math very well. If you see the operating leverage kick in or the demand come back, you will see the margins actually come back very sharply. Okay. In fact, let me give you another data point. At a contribution level, our margins in June quarter about 2.4% up over last year. But that's
when
lost
do we get to double digits?
Because of
Anuj, when do we get to double digits? Which quarter?
Nigel, you'll keep asking me that. It's not going to happen this year. We don't give a projection, but it's definitely not this year. But that's fine. The trajectory is important for us.
Okay. You hinted at pricing pressure. I'll tell you, and you said premium share is going up. That is good news. But I remember a year and a half out back, I bought a fan for my house. I paid some 6,000 rupees, one of those remote fans, and I think it was by a company called Atomberg, which has done very well in that segment, which is posing competitive pressures. Last month I bought the same fan, and I think I ended up paying some 3,500, and it was not in one of those sales. And this is the premium segment that you're talking about, Anuj, right?
That's right. Yeah.
Is there tremendous pressure even in the premium category?
Yeah, so I think the pressure is across, all consumption products because of the soft demand environment, and then each company is having their own pricing strategies, and at an SKU level sometimes varies. I would say, what you're describing is almost like a 40 to 50% discounting. To be honest, that's probably an aberration. I don't know the specific model comparison that you're giving. I wouldn't say it's that sharp, but I would put it the other way around. With the new star rating regime, there's almost a 10 to 12% cost side increase that is not passed on. I think we have a 4 to 5% cost impact that we are taking in as players here. The last point I would want to mention, the fan you're talking about clearly is probably a BLDC fan, and that's probably a 5-star rated fan as we call it now. What you will see happen over the next couple of years is that today the market is kind of polarized between a 1-star and a 5-star rated fan, but you'll see the emergence of a 3 and 4-star rated fans over the next 2 years. That's pretty normal across, look at ACs, refrigerators, etc. And that will give you a greater, sweet spot for consumers to actually go in for.
Okay, all right. We'll let you go on that note. Thanks a lot for joining in. That's Bajaj Electricals. But let's get back to the market now. It looks like the opening is going to be marginally in the green. So let's see how that goes. The street would like that. The mid-cap index is doing better. You have HCL Tech, which is your big gainer on the back of that huge order. And even Hero MotoCorp is looking pretty good. But Mitesh is still sitting by with us. Mitesh, what's the big call at 9:10?
I'll go with the buy on Sun TV. Look for targets of 570, 575 and a stop below 540.
Okay, Mitesh, thanks a lot for being with us here and joining us in the studio. Abhishek is joining us as well, our colleague, to talk about Manappuram and why he's watching that one. Abhishek, over to you.
Well, brokerages have written on Manappuram post the results. They say that earnings beat is on account of higher NIMs, and the NIM has been aided by the yield. Even my calculation shows that 150 to 200 basis point improvement in yield on a sequential basis, which has aided the net interest margin. MFI growth has been muted in Q1. Gold tonnage has declined while the customer base has remained stagnant or flat quarter on quarter. So the valuation of one-time FY25 price to book value is much lower than historical trend of 1.4 times is what analysts say, which undervalues the strong underlying non-gold portfolio, which is growing very strong. Earnings forecast has been revised anywhere between 6% to 13%, and ROE has been revised upwards as well for both FY24 and FY25. Just to alert our viewers, the stock had entered into F&O ban yesterday. The new target price by BofA is 178. CLSA has a target price of 175, while Morgan Stanley has increased the target price to 183. Only Investec has a hold rating and a target price of 100 per share. Back to you.
All right, Abhishek, thanks a lot for that. Let's head into the market opening now. Looks like it's going to be a decent opening, actually. The Nifty is holding flat with a bit of a positive bias. while the mid-cap index is up about 0.3%. The stocks to watch undoubtedly are HCL Tech after that very large order that they won, $2.1 billion from Verizon. And then Hero MotoCorp as well, good set of numbers coming through. Couple of other names like, Ultratech Cement, Tata Steel, Tata Motors also indicating a positive start. But remember, both FIIs and DIs bought in the cash markets yesterday. So the bullish trend is something that perhaps can continue. Well, there you have it. The first tick on the index, very, very flat, very quiet. The Bank Nifty is the one, remember, that's been dragging its feet a bit, and that is once again opens with a cut of about 67 odd points. Okay, 82 points down on the Bank Nifty now. So, it is, that's where the real pressure is kicking in, really. Otherwise, the market is absolutely flat. No large pressure there. Let's talk about the big gainers. First, HCL Tech is soaring now, 4% higher. It's taken the entire IT pack with it. So, Tech Mahindra, Infosys, Wipro, TCS, all of them in the green right now. Power Grid is also holding up quite well, up about 1%. And then you have ONGC ahead of the numbers, is up about 0.5%. Dr. Reddy's, Bajaj Auto, TCS and HDFC Bank, a couple of other stocks that are holding in the green. But there's disproportionate gains that you're seeing on HCL Tech, so just keep that on your radar. On the downside, it's pharma stocks that are taking a bit of, coming in for some profit taking. Biocon is down about 2% post its numbers, but apart from that, Cipla, Sun Pharma, Divi's are all in the red right now. And then you have some of these consumption names like Britannia, etc. Britannia, HUL, both are in the red right now, down about 0.5%. NTPC is also in the red, down about 1.2%. So that seems to be the losing lot. But otherwise, it's the Bank Nifty that continues to drag its feet and pull the market lower, preventing the Nifty from getting well above that 19,500 mark. So slightly subdued start, you'd have to say.
Well, that's right, Sonia, but doesn't take away from the fact that the broader markets, they continue to see a lot of stocks that are doing well. Genius Power is up close to around 7%. Big opening out there. NBCC as well up close to around 4.5%, and REC is up close to around 4% in today's trading session. On the flip side, you have Page Industries that actually did well in the final hour of trade yesterday. That's giving back some part of that, so that's down close to around 3%. Alchem Laboratories as well is seeing some selling. That's down close to around 5%, and Apollo Tyres is down a good 3% as we speak. To highlight a few more stocks that are doing quite well, I think LIC, maybe valuation support coming in there. So I think the first tick on LIC was in the green. It was up close to around 5% approximately. So that's opened up with big gains. And Force Motors, I mean, what a big move is what we're seeing out there. For this week itself, the stock is up close to around 25%. Big move. Volumes as well picking up. Actually, it's only 50,000 volume as we speak. But that's locked in upper circuit for the second day running. Stock up 10%. What else?
Look at Supreme Industries, guys. I mean, 12% move on Supreme Industries. That's a huge one. I'm not sure if there is any news flow here, but after the results, the stock had come off a little bit. Not very much. I mean, pulled back 4-5% or so. And numbers, by the way, were, there was strong volume growth, but I think pricing perhaps was a little weaker, if I remember that correctly. But look at that. And on big volumes, it's a large stock. It's up 75% this year so far, including today's gain. So that's coming up in a very large way. So REC is another one, which is up about 5% with very strong volumes. LIC is coming up. I think we highlighted that 4% higher on LIC. That's on the back of earnings, which came through. It's been a stark underperformer, even compared to others in the sector, which themselves have not done very well. Relatively. Suzlon is up about 2.7%. Stocks at about, 21, 22. I can spot Ashok Leyland, which is up about 2.25% or so. And I think we highlighted Biocon, where there is sharp year-on-year declines. In numbers, 2%, 2.5% lower on Biocon. Stocks at about, 240, 255 or so. So this is the bulk of the action that we are seeing. I think... a few other names. Kirloskar Engineering is up 6% or so. It's, again, highlighting stuff with large volumes. Motherson is up about 3%. Adani Wilmar comes up with a 3% pop, 384. If you can have these names up, please.
Just one point, Prashant. The Supreme Industries is because of the inclusion in the MSCI. That was a surprise factor that came in there. Nimesh and Vivek are just informing us. So that's the reason why that one is flying away up 13%.
Yeah. Wow, that's a really large move which is coming through. Now, HCC is another one which is up 4%. Force Motor, you highlighted, Nigel. GMM Pfaudler is coming up with a 7% gain. So lots of new names. KPIT Tech is up 2%. Ashapura Mindchem is up 12%. Genus Power, finally the stock crosses 200 rupee levels. So 6% higher, 6.5% higher. And I can go down the list. There is lots more. Himmatsinka Seed is up, 8% or so. So a fair bit of activity. Sonia?
Just one stock on the downside that I wanted to point out is Apollo Tyres. We spoke about it in top 10. It's down almost 3% right now. And that's because while in the European markets, for a lot of auto ancillaries, things have improved, especially the EV-focused auto ancillaries. Things have improved in Europe because of this huge transition to hybrid and EV vehicles in Europe. For some of them, like Apollo Tyres, they're still struggling with that segment. So there's a degrowth in the European market for them. And that's why the stock is under pressure. And of course, you know, you've had a big run-up in the stock as well. It's up almost 40% from March.
Yeah, absolutely. Alchem is another one, right? Alchem is down 7% or so. Right now, 38.49, 38.50 or so. I think numbers came out yesterday. So there is that cut coming through, large cut coming through on the back of large volumes as well. And maybe we can put up Avalon, which is the EMS player. That is down about 11% or so on decent sized volumes for this point in the day. So, you know, stuff is moving around and coming in hard. Through and through. We've got advanced decline, which is broadly, in favor of advances, almost 2:1 actually. So pretty strong, 1,200 higher and about 650 stocks, which are lower on my screen across the board on the NSE. Okay, let's welcome in Vineet Sambre, who is head of equities at DSP Investment Managers. Vineet, great to have you back on the program. Thanks very much. Prashant this side. The general kind of comment has been that with bulk of earnings now with us for the first quarter, then it's been an inline kind of quarter. And that may be true, but what has that meant for earnings expectations for FY24, Vineet? I suspect we've got once again more downgrades to full year estimates as compared to upgrades. Would you agree? And what does that mean for markets from here?
So, Prashant, as far as the overall earnings momentum is concerned, and when we think about the current year, I would like to stick to my general thesis that what may look like happening this year would be, we'll have in a lot of the sectors margin expansion playing out. And that actually we are watching as far as the first quarter results are concerned. Even the fourth quarter to some extent reflected that happening. And my sense is that we will see this trend only sort of improving, because what we are seeing at the margin is a lot of the raw material which were hurting many of the segments right now. They are seeing moderation, and that should help. So I think overall, if I just go by even the first quarter results, I don't know, what I was sort of reading is that I think about 60-70% of the earnings are either in line or they have been better than the expectations. And I would in general go by the thesis that maybe we could see still about 15-17% kind of earnings growth for the year. So that's my assessment. But I think things are very fluid. We'll have to just look at the environment and maybe keep revising the estimates if there are any big changes which takes place.
Okay, Vineet, I wanted your thoughts on what's happening with the banks, because even today the bank Nifty is down almost 200 points, right? And we're not even in the first 10 minutes of trade. What's going on here? Do you believe that the worst, or rather the best of the bank's margin performance is behind us? Is there going to be margin moderation from here? And if yes, what do you do with the banks that you hold in the portfolio?
I think you're right, Sonia. I think most of the worries is around the fact that we have seen the peak margins. And I think after the bank's outperformance, maybe there is some bit of that consolidation at the current level. People may want to watch how the interest rates really move and what kind of bearing it has on the margins. But, we have done a lot of our own sensitivity analysis around the banks. There are, 3-4 things which still keeps us positive on the banks. One, even if we see the margins have peaked out and maybe we may see some bit of, margin corrections if the interest rates were to start going south. But more importantly, I think the credit environment is still pretty good. I would say there are competitive pressures and all of those. We are listening to that. But I would still say the banks, the large ones definitely are getting their share of the growth. and the credit quality in the system is still okay. And we won't come to know till the time the credit quality actually starts getting affected. But I think at the moment there are no signals which are telling us that. And third and most important aspect has been the valuations are still maybe okay, considering the fact that some of these are more fundamental and more positive to the banking sector. So as far as we are concerned, we are not taking any different stance than what we had. We continue to own in a lot of our portfolios. Banking is an overweight segment, so that continues. We've not taken any different stance as of now.
Okay, what about something like autos? I'm asking because after a 3 or 5 year lull, the auto sector is coming back in a big way, right? Especially some of these players in the CV sector. I mean, Ashok Leyland is at a fresh 52-week high today. So which are the pockets where you still see valuation and growth headroom?
Like I have been actually highlighting that auto has been one of our sectors which, we favor at the moment, because like you mentioned, I think we are coming out of a low cycle and we'll see the next 2-3 years of good cycle. Now, which pockets to sort of focus on is something, we have to keep also looking at the valuations and maybe keep rebalancing our portfolios. But more importantly, where we have, felt, let's say, a bit of more comfort is owning auto ancillaries to play the auto sector revival, because there you are not really worried about any specific cycle going up or down, and you're broad basing the growth overall. And also, the other thing which, if one has to really maybe explore an option, two-wheeler as a category has not done well. They are still lying low as compared to their, 2019 highs. And maybe with the rural revival, which one is sort of anticipating with maybe election-led spending, or rural in itself doing well with the agro food prices doing well, maybe that's one segment which still gives you margin of safety. There could be, one can sort of think of exploring that area as well.
Hi, Vineet. Good morning. Vineet, what about the FMCG pack, and in particular ITC? They were making the right sound bites and now some action as well. I don't know whether it's fallen short of what the street expected with regard to their hotels business. But what's your view out there? I think you'll hold it in the portfolio.
So I think, there are, one can't really correlate ITC with purely FMCG, but I think there are, comparables when one looks at the smaller piece of business which that owns. But without getting into a lot of details specific about ITC, we are continuing to own that. In general, I think FMCG, we have an underweight stance. But as I said, I think as we look at the rural economics or the rural economy, starting to do well, maybe, and also what I was talking about, the raw material price pressures sort of, moderating. I think those could be the positive factor for FMCG, just that the valuations is something which basically keeps us away from the sector. But I think incrementally we are sort of, exploring the few options there. In a few of our portfolios, we have mid-cap FMCG plays as well. So I think overall, that maybe the next 2 quarters could be interesting from the FMCG's perspective as well.
Got it. By the way, have you, this companies like PB Fintech and Zomato, etc., where there is a fair bit of focus on profitability now? Do you own anything there? And any thoughts? Because stocks have also run up, though. I mean, some would say a little too much. I mean, we had Suresh Ganapathy of Macquarie put out a note on PB Fintech saying, there is markets are valuing it very richly. Any thoughts at all?
So I think, Prashant, still maybe there's some more time. We need to sort of give them some more time to see how they really, showcase profitability, what kind of visibility they are able to provide. I believe the environment is still challenging, and also if you see as an option, there are multiple good options to play where there are already established businesses which are really doing well. And one is not starved in terms of ideas as of now. I mean, evaluations, as I can say, is something which one has to be careful about. But in general, I think we have tried to sort of, stay with some of these established ones, and maybe some of these new areas where they are talking of profitability. That is a good point, but we need to watch them. The environment is pretty fluid as of now, so I think maybe give them some more time and before we take a call into some of these things.
Okay, we'll let you go on that note. And one sector that we spoke about, autos and auto ancillaries, that's on our radar right now. Thanks a lot for joining us. We have Bharat Forge, which is at a fresh 52-week high after reporting a solid set of Q1 FY24 earnings. The company witnessed a strong growth in two verticals, defense and aerospace. The total defense export orders are now at over 2,300 crore rupees. The passenger vehicle exports and the domestic non-auto business also saw a stellar growth this time. To discuss more on this, we're joined by Baba Kalyani, the Chairman and Managing Director at Bharat Forge. Mr. Kalyani, always great speaking with you. Hope you're in the best of your health. I want to start by asking you about the defense business, because after many years of, being in this incubation period, finally we've seen the defense business grow quite a bit, and you have order book in excess of 2,300 crores. Tell us, what is the revenue visibility like for over the next couple of quarters, and what kind of sustainable growth can you see in the defense vertical?
See, most of our defense business today, I would say 80% of this currently is all exports, which is a big surprise to us because we see huge demand coming from different countries for different products. And one of the reasons why we are getting so much business is all these products have been designed and developed by us. The IP is owned by us. So we are not dependent on some technical collaboration or tie-up or joint venture or something like that. So I think that's a good strategy that we have pursued for the last 10 years in defense. On the domestic side, there is a huge pipeline of orders which are under, let's say, the whole process. The process is quite complex. And so we are very confident that our defense vertical will show stellar results quarter after quarter.
So can you give us some numbers in the domestic side? Because I do understand that, things in India work differently from the export market. The timelines are a bit stretched out. So on the domestic side, what is the quantum of the defense orders that you're looking at currently? Any ballpark number? And in terms of a timeline?
I can tell you that if you look at artillery guns, there is already a discussion going on for 307 guns of ATAGs. There is another RFP for mounted guns, which is also of similar number. So between the two, you're looking at something like, and on the ATAG, there are two players, Tata's and us. So it'll get divided. And on the mounted guns, there may be more than two players, but ultimately it will get divided in two players. So we are looking at least in these two areas, the opportunity in the next, let's say, 1 year of getting orders is anywhere between 3,000 to 5,000 crores.
Wow. All right. Good morning, Mr. Kalyani. That's a big number then. So a tremendous potential. You're sitting on a good order book as well. But what's the execution going to be like for the defense vertical itself? I think in the first quarter, defense contributed close to 250 crores. For the year, what kind of revenues can you do from this vertical?
We are targeting this year, our financial year, to get to somewhere around 1,200 crores. But that will be, say, almost like 800-900 crores of exports, and then the remaining domestic. And I think next year we would like to double this number.
Okay. Sorry, Mr. Kalyani, hi, good morning. Good to be speaking with you. You said the ATAG is for 300, 300 in number. The mounted guns is again 300, and the order value accruable to Bharat Forge could be between 3,000 and 5,000 crores. Is that correct?
Yeah.
For the opportunity for the company is between 3,000 and 5,000 crores.
Plus we have multiple other programs that we are working on.
Okay. But for ATAG, by when will we see an award this year, Mr. Kalyani?
Before December. That's the plan of the Indian Army.
Okay. And for mounted guns, you said it's an RFP stage. Yeah.
Maybe maybe 1 quarter after.
1 quarter after. You gave us some numbers for the revenues that you expect from the defense vertical as a percentage of overall numbers. I mean, could you give us? Is there a sort of internal target in mind? What do you plan to get to, say by in the next 1 year or so? What percentage of revenue?
I've always maintained many years ago that Bharat Forge will strive to become a artillery house on a global basis. And that was based on our, let's say, strategy that we will develop these products ourselves, we will create the IP ourselves, and we will create the best products on a global basis. And I think we're beginning to see the fruits of that.
Absolutely.
Almost, I would say 60-70% of the world today uses artillery products which were designed 60 years ago.
Yes. Mr. Kalyan, sure. No, we got that. I mean, these are some really optimistic estimates that you're putting out, and the street likes it. The stock is surging as we speak. So you're saying 1,200 crores revenue in the defense vertical in FY24, looking at around 2,500 crores in FY25. So that's doubling over there. I want to understand a little bit about what this would do to your margin profile over the longer run. Because in the standalone business, you've been steady state at 25% margins for 3 consecutive quarters now. Is there scope overall, both for standalone and consolidated, to grow margins further?
You will see, consolidated is a little difficult question to deal with in terms of margins, because for overseas, I cannot generate a 25% margin. I think we all know that. But if I look at the India business, what we manufacture in India, I would see a steady increase in our margins from 25% more towards 29% over the next 3-4 years.
Okay. So, I wanted to also check with you. I mean, since you said that in the consolidated business, it's a bit hard, you've also been working to reduce your losses in the overseas subsidiaries. So I was going through the numbers. I think from a loss of around 150 crores in Q3, overseas subsidiaries losses are now less than 100 crores. At what point do you think you can turn into the black?
I think by the end of the year. We have said that, I've said that in our quarterly update, that by end of the year, we will turn these companies around. Europe is already turning around. The challenge is in the US because it's a greenfield operation. And, we unfortunately did it during the COVID period, and with all the problems that you can get in COVID with people and delays and everything else, it's been a challenge.
Okay, I have one last question on the earnings. But before that, since defense is such a big opportunity and you are in the thick of the things at the moment, I just want to check with you, is there any more, capex that you will need to put on board, any more debt that you would have to take on board in order to get this defense plan running? And anything from the government's end that needs to be done in order to streamline this process further?
Let me answer your second question first. As far as the government is concerned, I have never seen a more helpful government process right now for for us at least, to get our defense act together, especially on exports. I mean, they have been going out of their way to make things happen. So we are very happy with the kind of support that we get from the government of India, the Ministry of Defense, the Ministry of External Affairs. I mean, everybody is involved in this process. So it's great. I think and the Honorable Prime Minister has put a target for exports on defense, and I think that's being pursued pretty seriously by the system. So that's good news as far as defense is concerned. But, please, as far as CapEx is concerned, we are now, I just said in our first quarter review that we will spend roughly about 1,000 crores in CapEx in 3 areas. A large part of that will go in our existing business, because our existing business, we are following a strategy of last man standing, and we are inundated with business in our existing business.
Okay, that's a great way. That's a great way to end the discussion, Mr. Kalyani. You're inundated with business in the existing business. It's always a good place to be in.
Yeah.
Thanks a lot for joining us. Yes, go ahead. Complete your point.
And the third area where we are working very hard is to create a new industrial business. Because we see as India's overall economy grows up, the GDP grows up, the industrial side of India's business will increase at a dramatic pace. Right now, it's most of the industrial products are imported. So we have created, we've just bought some companies that make castings. We are now converting them from components to products. So there is a whole strategy in place of creating a fairly substantial industrial business in the next 3, 4, 5 years.
Okay, and all the best with that, Mr. Kalyani, and thank you as always for joining us and speaking to CNBC-TV18. That's a very optimistic Baba Kalyani, looking to double their revenues in the defense business from 1,200 crores to 2,400 crores by FY25, and big targets there. The stock is up and about. But the other stock we're looking at is Motherson International, reported another strong set of numbers. Revenue growth of 27%, operating profit margins expanded as well. In fact, the EBITDA, the management said, is driven by operating efficiency, softening of raw material costs and softening of energy prices. Pankaj Mittal, the CEO, and Kunal Malani, the CFO of the company, join us now. Gentlemen, morning to both of you. Kunal, I want to start with you. This growth that you've seen, right, it's almost a 30% growth that you've seen across your businesses, whether it's wiring harness, vision systems and polymer segments. Is this something that is sustainable in the, for the rest of the quarters in FY24?
Yeah, absolutely. I mean, if you look at our order book that we disclosed last quarter, it was $70 billion. So obviously we are going on that run rate. Hopefully, as the automotive market is still seeing growth, thankfully, and as that plays out and the 70 billion gets into execution, we should be seeing more growth going ahead.
Okay. If you look at the segmental wise breakup, right, the wiring harness business, I think for the first time you've seen double-digit margins there, 10.2%. What's going so right in this business? Have you managed to sort of get new clients on board? What is the order book situation like? And what kind of sustainable growth you see, particularly for wiring harness?
Pankaj, you want to take that?
Yeah, so the teams probably have been doing well. So we have had lots of challenges, as you know, after COVID, and they have been kind of settled. So with the customers' trust, of course, new customer additions have taken place. Certain geographies in the past were hit due to sudden volume changes. That stabilization has taken place, and that's what results in better performance all across.
Okay. So, I'll come back to the business side of things in a bit, but I also, Pankaj, want to check a little bit with on what's happening with the debt situation. Because, the net debt has risen. It's now at about 8,300 crores versus about 7,500 crores last quarter. So on a quarter-on-quarter basis, it's a 12% rise that we've seen. So that is a bit of a troubling issue for the market. But you've given an explanation saying that there were some payouts of acquisitions that you had to make during Q1, etc. But do you plan to bring down the debt substantially at any point in time? And if yes, what could how much could the debt come down to in FY24?
Well, I think Kunal will add more to it, but I would say that you see us as a very fast-growing company. We have already announced many acquisitions. So as we move forward, there may be debt, but when you look at our leverage, that's what we look at. So we have maintained our leverage, and what we are saying that going into the future also, while the leverage may go up for a short term to medium term, but then we again bring it back. So that's the kind of direction with which we move with a very growth-oriented company. Kunal, you may kindly add.
Kunal, you want to give us a number as how much you can bring down your debt by?
Look, I think there are many still volatilities around, so I don't want to second guess where we'll end on. But what is amply clear is we are on a deleveraging path when it comes to our organic set of the business. What you have seen currently as an expansion is on account of working capital, again, partly driven off the execution of the 70 billion order book, which requires us to do our engineering upfront, and hence those are lying in working capital right now. As the order starts into production, those will get sold off, and hence the working capital decline. So as we head towards the latter part of the year, you would see a decline in the net debt from the perspective of our organic business. What Pankaj was mentioning is on an absolute level, the debt will still increase because, as you know, we've announced 12 acquisition targets, 7 which have closed in the last few months. And those will start kicking in as we go ahead from both top line and bottom line perspective. And hence the leverage ratio, after considering all of those by the end of the year, give or take, should be in and around the current levels, give or take. We do not expect actually the peak leverage to go beyond 2x in spite of the last 12 acquisitions that we've announced.
Okay, so you're saying that the debt will rise further because of the acquisition costs, etc. But your net debt to equity, you're not going to go above the 2x level, right? I got that.
Net debt to EBITDA, just to be clear.
Net debt to EBITDA, okay. Now, I want to talk to you a little bit about the aerospace vertical. We were just having this chat with Baba Kalyani as well, and there's so much work that you folks are doing there. You've also started supplying new product ranges to the aerospace vertical. You've acquired Sirma as well to supply wiring harnesses there. But you haven't told us about the quantum of business. What is the opportunity size for you in aerospace, and what is the order book like?
Look, the order book from the time we acquired SimTools has grown more than 3x. And we will come back with more disclosures around this every 6 months. So next year or next quarter, you will hear more specifically on some of these newer verticals that we have. But it's extremely exciting times on the aerospace side. Sirma is a classic example of all the hard work the team has done. And we've been able to get this asset only at the behest of the customer. So this was completely asked by the OEM here to be able to go into this asset, looking at all the good work that we have done on the wiring harness side in the automotive space. So it's up our alley. It's an entry point, and then we start growing very, very significantly from here. Needless to say, India is a large market on the aircraft side now, and that is also helping us by being an Indian player to be able to capture much of the growth in India as well. So it is on a significantly higher trajectory, let me put it this way, than the current growth that you're seeing at an aggregate level.
But can you give us some numbers? I mean, if you're saying that it's going to double or go up 3x, what is it at currently? And how much, say, by the end of FY25, what could the order visibility, the revenue visibility look like for this vertical, aerospace?
We'll come back, as I told you, we'll come back in the 6-month period when we talk about this more specifically.
Okay, got it. Pankaj, one thought from your end on the margins as well. I mean, you're almost at 9% margins on a consolidated basis. Is there scope to increase margins further? And if yes, what would the levers be?
See, it's been a very exciting time for all of us. And while the markets have stabilized, still there are certain challenges which are there, like wage costs and the higher interest costs. And we are all navigating through these challenges. So, of course, for all of us, it's very important that we focus on return on capital employed, and we continue to focus on that. But the whole direction for all of us is to move up and make ourselves better.
I just one quick question. I don't know, Pankaj, you want to take it? But I was reading that you guys have done some 7 acquisitions, since April of this year, right? So very, very prolific in that particular department. How is the integration of all of it coming together? If you can give us a quick sneak peek. And, I'm assuming you will start to consolidate all of this starting this quarter, that is Q2. What should we expect in terms of addition to overall numbers from these acquisitions?
Kunal, would you like to take that?
I think, a couple have been closed in this quarter. So in the current quarter, if you look at it, the revenue buildup is only actually 26 crores. Going forward, the larger one, SAS and Ichiko, has been closed on July 31st. So you'll start seeing that traction come into second quarter. The aggregate revenue has been around about 1.1 billion historically. So that's what you would expect on a full year basis. Give or take, as we come into integrating these assets. It's relatively early days, as you said, from an integration perspective. July 31st, we're talking about 10 days since then. But overall, I think we've been happy with both how the industry trends are looking like for these assets, as well as the capabilities that these assets bring in. So the growth will actually not only feature in these respective assets itself, but the objective would be to leverage some of the capabilities that they have and make our existing products and capabilities even better. That would be the endeavor. So hence we're looking at a fairly synergistic level of growth coming through as we move through the year.
Sorry, you gave that 1.1 billion number. What is that?
That's the top line of the acquisitions which have closed.
The total acquisition on an annual basis?
On an annualized basis. That has closed, the revenue mark of that. The gross revenue mark of this will be 5 billion.
And any more acquisitions that are lined up in the latter part of the calendar year? And if yes, what are you looking at in terms of either geographies or areas?
Look, I think we are in a very interesting position. There are very few suppliers which have a strong balance sheet like ourselves, as well as the capabilities of being a global supplier. And that is a unique position when you start thinking about all the volatilities that are there around the world. And hence we get very favorably looked at by the customers who then ask us to find solutions for some of the troubled assets. So Dr. Schneider was again a classic example of that nature. So in this relatively volatile world where interest rates are peaking, inflations are peaking, the pain is obviously there, and we are seeing a great degree of traction around those. We remain fully engaged on the M&A side, and hopefully more will happen as we go through the year.
Okay, and we hope to hear from you very soon on that front. Thanks a lot, gentlemen, for joining us and speaking to CNBC-TV18. That's Samvardhan Motherson, where the stock is up almost about 2%. Good expansion in terms of margins. Key businesses are doing well. But yes, the debt is rising because of acquisition costs, and that's something that may continue. Let's step into a quick break. On the other side of the break, Ashish Jain, the CFO at KRBL, will be joining in to discuss the performance for their quarter. Stay tuned.
Welcome back. Well, as promised, KRBL is the next company on our radar. They posted a decent set of numbers. The revenue jumped by 15%, witnessed some kind of pressure on gross margins as basmati input cost increased. The domestic revenues grew by 19%, while exports revenue witnessed a growth of close around 11%. It was fully driven by volumes. To discuss this, what's the way ahead as well, we're joined by Mr. Ashish Jain, the CFO of KRBL. Well, good morning, Mr. Jain. Thanks so much for joining in. The numbers were decent, but more than the numbers, I wanted to focus on the buyback, because that's been the plea from the investor community for the last many years. I recall asking Mr. Mittal maybe 5 years back, why don't you do a buyback? And he said, maybe we'll take note of it. When I spoke to you in March this year as well, we asked you about buyback. So it's good to see you all have gone ahead with this buyback. So a couple of details out here first. What is the total cash in your books as of now, sir? The updated number?
The total cash in the books is around 1,200 crores.
1,200 crores, right? And the total buyback, I understand, will be around 300-350 crores approximately.
Yeah,
Wouldn't you think that you would have liked to do a larger buyback, to give more confidence out there? And also in this buyback, will the promoter group participate?
Yeah, so, in terms of the size of the buyback, it is 325 crores, that's excluding taxes, etc. And in terms of how we arrived at the size of the buyback, we looked at our fund requirements and we realized that, we have some surplus available for distribution, not for all the time to come, but at least for now. And that's how the decision on the size got taken. Now, in terms of the promoter buyback, so we'll be releasing a public announcement which will have all the details.
But the intent is for the promoter to participate. I'll tell you why, sir. Because you're doing this buyback of close to around, I think, 500 rupees approximately. Well, you'll have always maintained that the share is undervalued. That could be one of the reasons why a company goes ahead and does a buyback, and also surplus cash. You've given us a rationale about why you intend to use only around 325 crores. But if a positive signal wants to be sent out, then the promoter entity ideally should not participate. Your thoughts?
Yeah, so, I see it differently. I think for us, this is fundamentally a very good tool to distribute surplus funds to the shareholders. The other tool, of course, is to continue giving dividends, which we continued this year, subject to the shareholder approval. So that's really the principal agenda. Now, in terms of whether promoter participation, should they or should they not, I think that's a totally separate question.
Ashish, hi. Good morning. Prashant this side. So let's move away from the buyback to some fundamentals. So the government banned the export of non-basmati rice, right? Does that in any way open up any opportunities for you in the basmati segment to target some of those markets? They're completely different segments, one. And go on.
Yeah, no, so you're right. I mean, the restriction has come about recently. From our point of view, we don't see it as a major opportunity. We see the two sets of consumers as very different. Consumers have very developed taste of rice, what they want to consume, and therefore the migration from one to the other is not something that we see very often. However, I think overall there is a fair bit of anticipation in terms of what is happening to the global rice market. So I just want to touch on that. So there we see the following picture emerging. Now, when we see forecasts from various informed agencies, we are yet to see a downward revision on the overall forecast. So despite the fact that there are some major rice producing countries who are reporting deficient production because of El Nino, etc. However, the overall forecasts are yet to change. Sure, the prices have gone up practically for the last 12 months, 15 years, and more so recently. But like we've responded recently, we expect the prices to come down and settle down. So we see the surge as a short-term one. And on our business, direct impact of non-basmati ban, very minimal.
Okay. Just to take that point forward, I mean, if you look at in the Indian context as well, because India is a huge exporter of rice, at least was before this ban came through. So sowing data shows that, for pulses, for example, sowing is down some 9%, 9-10%. I think for rice also it should be down. So when you say there are many who believe that actually, we will be in a situation where there perhaps may be at the margin some shortages, etc. So prices actually go up, not come down. So just wanted you to respond to that.
Sure. So, if you look at the latest rice showing data, at this point, it is about 3 to 4% up over the sowing at the same time last year. So, if we take this as an early indicator, there is no need, to form a view that the production this year or the crop this year will be deficient. Of course, there is a long way to go, and there are several agroclimatic factors at work. But at least on that indicator which you mentioned, there doesn't seem to have any cause of concern. And which is one principal reason why I believe that prices should settle in the future.
Okay. Ashish, hi, good morning. So let's come down to the numbers, right? Just a couple of numbers from your end. What could the volume growth look like for you in the second and third quarter of this year? You did about 11% in Q1.
Yeah. So, we are continuing to see strong volume growth in the domestic market. I think a couple of factors there are playing up. Some of them are connected to what we are trying to do in terms of conversions from loose to package, etc. So the domestic market, we continue to see as strong. Export is a little bit of an evolving situation. We are doing a distribution refresh in two of our key markets, and we expect that to settle down by the end of quarter two. So quarter three, quarter four, one should see, a step up from quarter one numbers on our export. So overall,
overall, what would it be? Would it be in high teens, the volume growth? And can you break it up for us? Domestic, since you said domestic is very strong, will it be in high teens for Q3 and Q4? And also on the margin front, do you hold on to 20%?
Yeah. See, in terms of margins, we've said earlier as well, I think over longer term, we look at somewhere between 15 to 20%, somewhere I would say around 17 to 18% as a long-term average. We stick to that as a long-term estimate. Now, in terms of volume growth, I think we are positive on the domestic picture. Export is an evolving situation. We'll have a clearer picture at the end of Q2.
And what about the revenue growth, sir?
Yeah, so I think it looks like it's on track, but again, clearer picture by end of Q2 that's when I'll want to come back to you with a firmer number.
And I think by 2025, we have a target of doing around 7,500 to 8,000 crores, right, of revenues?
Yeah, so I mean, if you look at the drivers of that, I think they seem to be falling in place. On the domestic side, we've seen very strong response to our non-Basmati initiative. The revenue is small, but it's grown by 60% on a year-on-year basis. So that's well on track. The Basmati consumption itself is growing, and that is a positive factor. Export, we've done well last year, and we hope to continue with that. So I would say we are on track on that.
Okay, all right. Thanks a lot for joining in and all the best. That's KRBL with their view on the overall business and how it could shape up from here. But Mitesh is back with us in the studio. Mitesh, I think it's going as per plan, right? The expectation was that we would be slightly weak. And here we are. The Nifty is now down almost 80 points. It's completely dragged down by the Bank Nifty. What do you do at this juncture below the 19,500 mark?
So, Sonia, I think the level which I'm watching, for some kind of accelerated supply towards 19,200 would be around 19,425. So that's where a trend line comes in. I think if we start breaking below that, I would expect and suspect another correction of 200 plus points. So 19,200 then could be visited. So till then, trading with stock specific prices, we have been holding put options in both the indices. We continue to do that. And on the stock side, I have one buy and one sell call. IRCTC, if you look at the first hour of movement, is giving some kind of a breakout on intraday hourly chart. So that's a buy with a stop at 655 for targets of 695. And Concord has had a negative gap down opening. It's trading near the 200 average, but I suspect more downside could happen. So that's a sell with a stop at 687 for targets of roughly around 630.
Mitesh, sorry, names like Supreme Industries, any thoughts? That's a rocket this morning.
Oh yes, in fact, if you look at the last few weeks of data, Prashant, the stock has risen from 2,400 now to 4,200 in a matter of less than 3 weeks. Very, very overbought. So I think difficult to enter over here, but I can suggest a trailing stop loss for people who are holding this. 3760 is the level. It's still 10% down, and the stock itself is up 8% today. But 3765, I think, is the medium-term trend reversal level. Till that doesn't happen, sky is the limit because this is in all-time high territories.
One more name, Genus Power. It seems to have finally broken out of this, 180, 190 odd level where it was for the last, and actually since the beginning of July. Genus Power.
Yes, a very good breakout. In fact, today morning is given a gap up and made a fresh swing high. So this gives you a good entry point with a minimal risk. I would suggest a stop at about 190 and a target of around 240 in the next couple of weeks.
Okay, all right, Mitesh, we'll leave it there for now. Thank you very much for joining us. And it's a pleasure, as always. We'll take a quick commercial break here, focus on commodity markets when we come back. And there's more coming up on stock-specific action as well. Stay with us.
Welcome back to Bazaar Corporate Radar. Well, we have the commodity segment that we're looking at right now. Manisha is with us. Manisha, what's the one commodity that you're tracking today?
Sonia, I'm looking at the metals as a sector, and this is going to be a second weekly decline that many of the metals are really posting for this one as well. So just to get the report card on your screens here, we are looking at copper prices trading at a 1-month lows, and we have seen prices decline by 2%. Steel and iron ore prices are trading at a 2-month lows with 2 to 5% of a decline coming in for these as well. The other metals also are trading in the negative, whether it's about nickel, which has been an underperformer with nearly 5.5% of decline coming in. The less declines really came in for aluminum and zinc, where you are looking at 1 to 1.5% of a cut in any case there. Well, the strong US dollar has continued to wait. This is the third straight week that you are looking at the dollar index trading at above 102. That has been weighing on dollar-denominated commodities. The second is the weak global economic data, whether it has been from Europe or Chinese number, the trade data or the deflation numbers that came in, all of that has led to profit taking coming in for this sector. When you look at copper, while we have seen the Chinese imports decline by nearly 10% for the month of July, the overall China copper inventories are down 15% in the previous week. That should have lent some support, but we haven't seen that come into the markets. In case of other metals, when you look at zinc, well, the global demand for refined zinc is expected to gain up by nearly 1.4%. That is the view coming in from S&P Global. Is the reason you haven't seen that kind of a decline in zinc as you have seen in other metals. For zinc as well, while the consumption continues to increase, the production hasn't gained up so much. So zinc is one of the better performers there. When you look at aluminum as well, here too the demand has been strong. China has imported 10.7% in the previous month. And as far as production for aluminum goes in Europe or China, because of our rationing, we still are looking at the production on the weaker side. So that is still supportive. So when you look at the overall sector, even as we are trading in the weakness, copper, zinc, aluminum are perhaps the metals to keep an eye on. These have been trading comparatively on the higher side.
All right, Manisha, thanks very much for that. So that is commodities in focus. Well, the Nifty is down 85 points, but we've been highlighting so many names which are, buzzing. Market breadth is still positive. Look at something like a rate gain, for example. Numbers came out, earlier this week, I think Monday or Tuesday. The stock has been steady over the last few days when the market's been a little leafy, and it's now approaching the 550 mark. So another 5% on rate gain. Okay, I think it's down about 0.25%. All right, I think the prices on my screen perhaps not updating on this one. But it's held steady, not declined along with the rest of the market. Rima is now joining in. HCL Tech, let's just refocus back on that particular name after the big transaction, big deal. Rima.
Thanks so much for that. So HCL Tech has won a mega deal. It's a $2.1 billion deal from Verizon. It's a net new deal, and it will be spread over 6 years, starting from November of 2023. If you do a simplistic calculation, that's $2.1 billion divided by 6 years, then you come to an annual revenue figure of about $350 million, assuming a linear, execution. Though the ramp-up schedules do differ, but on an average, it can, on an annual basis, add about 1.2, 1.3% to the FY24, FY25 revenues. This provides the street a lot of comfort in the company inching closer to achieving its full-year guidance of 6 to 8%. Morgan Stanley's overweight on HCL Tech. They say such deals should lower the perceived risk of a potential revenue guidance cut at the lower end. With this announcement, they expect some of the underperformance to reverse. So after, in HCL Tech's case, the Q1 numbers were very weak. So the street was fearing that the company will lower the full year guidance because after such a weak start to the year, they thought it's not even possible for the company to achieve 6%. That's the lower end of the guidance. With this deal, there is some comfort in the company achieving that. JP Morgan, though, believes that this deal could be margin dilutive. Back to you.
All right. Thanks a lot for that, Rima. Well, let's go across to Ekta. She's also joining in. She has Alchem Labs on her radar. Ekta, over to you.
Thanks for that. Well, yes, Alchem came out with its numbers yesterday, but what it's reacting to is basically the conference call takeaways. So the company has lowered its domestic business growth guidance. They're estimating India to grow at low double digits to high single digits versus high single digits for FY24. The management, however, retained its guidance of 16% EBITDA margin for FY24. The company expects to expand the EBITDA margin by 50 to 100 basis points each year post FY24. Now, in terms of Alchem this quarter, India was impacted due to factors such as a delayed monsoon, slow sales of the acute therapies, and analysts say the commentary on the domestic Q2 also was so weak that they're not probably expecting something too encouraging in terms of a trend in Q2. Now, overall, however, cost optimization measures are on track, so maybe there could be some amount of cost saving going forward. Brokerages such as Bernstein have a market perform. They believe that the top line was a beat, but the margins were a miss. HSBC has downgraded the stock to hold. Strong volume uptake in India segment will be a key catalyst. BofA has an underperform with a target price of 3,500. Nomura neutral with a target price of 3,632.
Okay, thanks a lot for that, Ekta. Well, let's slip into a quick break. On the other side, Lata will connect with Abhishek Lodha of Macrotech Developers for a discussion on their Q1 numbers and the overall health of the real estate sector.